Yes, accounting for fixed assets. And this module is about the basic accounting for depreciation. The thing is that fixed assets belong to the main head, which is asset. And whenever there is increase, we debit fixed asset. People used to say that depreciation caused decrease in fixed asset. In fact, this is a wrong concept, because if we will say that depreciation is causing a decrease in fixed asset, then depreciation should be credited to the fixed asset, just as we credited debtors account because of the bad debt. Okay? Whenever the bad debts are written off, debtors are reduced. But here, because of depreciation, fixed assets are not reduced. As a matter of fact, depreciation is in fact an allocation of the cost of fixed asset over its useful life. Might be the value of the fixed asset is not falling down. And in the same way, physically the fixed asset is not deteriorating. So fixed asset would remain in our fixed assets ledger account at its cost unless we work out its revaluation. But the depreciation account will be accounted for along with its reciprocal effect in provision for depreciation account. And some authors also use accumulated depreciation account. Both are 100% same. So provision for depreciation account is in fact a contra to the fixed asset account, which is then subtracted from the carry forward balance of fixed asset account in the balance sheet as a presentation. Got it? So fixed asset account will not be reduced, or you cannot say will not be declined because of depreciation directly. Rather, depreciation will be accounted for with its reciprocal credit effect in provision for depreciation account. Let's see these accounting entries. So when we are buying a fixed asset, simple accounting entry, fixed asset account debit, cash account credit, or bank account credit, or accounts payable credit, whatsoever, the credit effect will be given to the relevant accounting head. And when there is a depreciation expense, being expense, it will be debited, and its credit will be given to the provision for depreciation account. Okay? And this provision for depreciation account is contra in nature, would always be credited. It is depreciation expense for the year. FTY stands for the year. Okay? And then profit and loss account will be used to close this depreciation expense. Just as bad that we closed into the profit and loss account or income statement. So in the same way, depreciation expense is closed to the profit and loss account. So it is a closing entry for expenses. Well, let's do a practice question on it. So the question tells us that in 2009, we had opening balance of plant and machinery, which is our fixed asset. We had opening balance of accumulated depreciation 10,000 with us. And in the mid of this year, 2009, on July 1, we are purchasing one more plant. So there is an addition of fixed asset during the year amounting to 20,000. So our accounting year is closing on 31st December 2009. In a way, from 1st January till 1st January is its opening date, and 31st December is its closing date. Okay, and in the mid of the year, we purchased a new asset on July 1. So it is its time bar. Well, we have to depreciate this asset at 10% using reducing balance method. And this is important. Depreciation bases are full year depreciation in the year of purchase. Okay? Always remember that while doing question of depreciation, these three things should be extracted: method, rate, and basis. Okay? Well, in second scenario, method, rate, and basis. Method is again reducing balance, rate is 10%, and now we are using time proportionate base. Either there will be full year depreciation in the year of purchase, and if there is full year depreciation in the year of purchase, in that case there will be no depreciation in the year of disposal. Okay, this is the base. Either this would be the base or time proportionate would be the base. Okay, so there are two bases to calculate depreciation in case we are buying an asset during the year or we are disposing of an asset during the year. Okay, got it. Well, so the second scenario is this, and the third scenario is that depreciation method is straight line, rate is 10%, base is full year. Okay, and the fourth scenario is method is straight line, rate is 10%, and base is time proportionate. Let's solve this practice question. In the first scenario, where there was reducing balance method and full year depreciation, so the thing is that we had a balance of 25,000 in the opening date. First, put opening balances in the relevant ledger account. We are preparing plant and machinery. It is our asset. And provision for depreciation, it is contra to asset. Got it? Well, so contra to asset means its opening balance will be put in the credit side, and asset, its opening balance will be put in the debit side. Then on July 1, we purchased one more asset in the debit side, and our carry forward balance is 45,000 in the credit side. The important thing is depreciation expense for the year. How we calculate this under this scenario. So opening balance of asset is 25,000 and opening balance of the provision for depreciation is 10,000. By subtracting this opening balance of provision from the opening balance of asset, we get 15,000. So we know very well under this reducing balance method, depreciation is applied on the reduced balance or on the net book value, which is 15,000 in this year. So 1,500 is depreciation charge on the opening balance. And this 20,000 was purchased during the year, although it remained in our use for 6 months only. You see, from 1st July to 31st December is 6 months. It remained in our use for 6 months, but our bases are full year depreciation. Therefore, we are taking its full year depreciation. 20,000 times 10% gives us 2,000. So here we go. This 3,500 is our depreciation expense, and we know its accounting entry, depreciation expense debit, and provision for depreciation account credit. Our focus over here is that provision for depreciation is credited with 3,500. And in second scenario, the thing is, again, we have reducing balance method, but base is time proportionate. Once again, put opening balance of both asset and provision for depreciation in the relevant side. Complete this asset account. We are clear on this concept. And now calculate this depreciation expense for the year. So how to calculate? The same way. Since it is reducing balance method, its depreciation will be calculated on the opening balance of net book value, which is 15,000 times 10%, 1,500. But since it is now a time proportionate base and we purchased this asset 6 months ago from the closing date, so it remained with us 6 months, 6 by 12. Okay, so 6 by 12 will give us 1,000. So total amount of 2,500 is our depreciation expense for the year. So closing balance of provision for depreciation is 12,500. Next is straight line method with full year depreciation. So the fixed asset account will exactly look like the same way. 25,000 and 20,000 in the debit side and will give us a closing balance of 45,000. Opening balance will also be put in the same way. But the depreciation charge will be calculated like, remember, straight line method, full year depreciation. Full year depreciation means that we have to calculate depreciation on the complete asset for the full year. It is straight line method. It is not reducing balance. So under straight line method, we calculate depreciation on opening balance for full year and on the purchase of new asset for the full year. So for total assets, we will charge this depreciation rate 10%. This 4,500 is our depreciation expense for the year and carry forward balance will be 14,500. Your concentration is required, please. Don't lose your concentration. Otherwise, you will lose the game. Please be careful. The next scenario is straight line method and time proportionate. Well, so the depreciation is calculated over here for this 25,000 means for the opening balance for the full year. But for this new asset for the time proportionate. So 20,000 times 10% times 6 by 12 would be 1,500. 1,000 and the total amount would be 3,500, which is there in the provision for depreciation credit side, so that our carry forward balance will be 13,500. And you would have observed that in all scenarios, plant and machinery account remains same. Even the structure of provision for depreciation is also same. The only amount of depreciation expense is being changed. So the important tips to remember the ITTRs in this module are that provision for depreciation is contra to asset. So it has credit nature. And the second thing is that depreciation is a charge against usage of fixed asset. If nothing is mentioned, when I'm saying usage, so the usage period should be considered 6 months in our example. But if nothing is mentioned there, means in the question, then nothing is mentioned in terms of the basis that time proportionate base is to be used or full year depreciation base is to be used. If this is not mentioned, then time proportionate should be done because it becomes logical then. Then the examiner is leaving to select your own base, to do your own working for calculating the depreciation based on your own logics. So the logic is that if number of months are given, you can calculate number of months. Question is silent about the base of calculating depreciation. Then you have to work out depreciation based on time proportionate basis. Thank you very much.